I was listening to a very interesting dialogue with a guy who runs a family consortium and consultancy and deals with a lot of high net worth individuals. And he was talking about liquidity and the value of being able to have assets that you can tap into as an alternative way to fund real estate and not sit and wait for rates to come down. So, as many of you know, most mortgages are income-based. How much do you make? Do you have the ability to repay? There's a whole nother section of financing, which is not based on your income, but on your assets. What do you have? Your 401k, your stock portfolio, your vintage Ferrari collection, your art collection, your wine collection, assets that have value, and can you use them as a source of collateral to borrow against at rates that might be cheaper? And I thought it was a super interesting comment because this fellow said he's advising most of his clients to use their assets as a source to get financing against and to borrow against until rates come down. So that's great. And so talk about this with your wealth advisor and say, okay, I have this assets, I have these assets, here's my portfolio. Is there a way, are there asset-based loan products that can help me get where I want to go if I don't want to use my cash? Because most people now are saying, stay liquid, don't touch your cash position. So if you don't want to touch your cash position, are there other assets that you can use? Well, that's great, Sally, right? I'm saying that to those of you that have that. But what about folks that don't have that? What the heck are you supposed to do? I'll say it again, and I've said it 20,000 times over the past couple of years. Rather than sitting and letting macro market conditions control what you can do, take control and see if you have a willing seller that will help you improve your rate position. What do I mean by that? When you make an offer, talk to your mortgage person and say, how much contribution can a seller make to me? And give them a stronger price, but say, okay, will you give me $20,000 or X percent towards buying down my interest rate? And try to get a couple of years. Because if you can get a couple years, you're going to be in a position where in the future, maybe you're making more money. Maybe in the future, you can refi to, an ARM that's fixed, or you can have a conventional loan if rates come down. And work with a seller that says, together, let's figure this out and make money more affordable for you so you can buy my house. So when you scratch out the math, when you calculate, okay, I'd rather go for human natures. I want to go for the lowest purchase price possible. And then you're paying, 6.5% or whatever the prevailing rates are right now. If you scratch out 6.5% on $20K off your mortgage, off the purchase price, well, and then you say, I'm going to give you a stronger purchase price, full price or just under, but you're going to give me $20K to buy down my rate. The savings you get with that, because you're leveraging most of your mortgage money on the purchase price, oh my gosh. First of all, you're the savings if you scratch it out. So think about asking the seller to together work with you almost as a partner, but you got to talk to your lender ahead of time and say, do I qual for the higher amount? Because you have to qual for the real mortgage. None of this wishing and hoping you're going to be able to afford it. But if you can qualify for it, try to work with a seller that gets it and wants to partner with you together to say, let's take control of this lending environment and buy down your rate. So if you have other assets, think about asset-based ways to beat the street for conventional institutional financing mortgages. And if you do not, try to find a lender that will help you figure out what buying down your rate would be, and then find a seller who's ready, willing, and able to help you do that. Those are my thoughts to help try to move you forward in this market. I'm Sally Daley from Douglas Elliman in Vero Beach. Have a great day.